All right, let's dive right into this explainer. Think about $300 a month. For some of us, that's a car payment. For others, it's just a phone bill plus a couple of quick trips to the grocery store. But what if I told you that this exact same amount of money is literally the difference between retiring early on a beach somewhere and working well into your 70s? Today, we're going to look at how a single $300 monthly investment yields vastly different futures, depending entirely on when you start. Just look at the stark contrast here. Same exact money, completely different outcome. If you invest $300 the wrong way or simply just start later in your 40s, you might end up with just shy of $400,000. But if you invest it the right way starting in your 20s, you are looking at a staggering $1.9 million. The variable creating this massive wealth gap isn't the market, and it's definitely not about picking the perfect stock. It's simply time. So this naturally leads us to ask, what exactly causes this massive divide? And more importantly, how can we optimize that $300 based on our current age? Because how you invest that money changes completely depending on the runway you have left before retirement. We are going to break down step by step exactly where that $300 should go, whether you're in your 20s, your 30s, or your 40s. Section 1, your 20s. Maximize your time. If this is you, I need you to hear this absolutely clearly. You possess the single most powerful financial weapon in existence, which is decades of time. Your biggest risk right now isn't market volatility. It's not investing at all. Here's the math. At age 25, if you invest just $300 a month into a broad market index fund averaging at 10% annual return, you're looking at approximately $1.9 million by age 65. You didn't have to stress over crypto moonshots. You just had to start and let the market do all the heavy lifting over 4 decades. So the absolutely crucial point here is splitting that money up efficiently. Here's your exact playbook. Step 1, put $200 into a Roth IRA. This is hands down the best account for your 20s because you pay taxes right now while your income is relatively low, and every single dollar grows completely tax-free for retirement. You can throw this into a simple fund like a total market or S&P 500 ETF. Step 2, take the remaining $100 and use it to capture your employer's 401k match. If your company offers a match, that is literal free money. It's an instant return on your investment that nothing else in the stock market can beat. Section 2, your 30s, finding the balance. Welcome to the decade of balance. You probably have a bit more income now, sure, but you have to balance it against growing responsibilities, maybe a mortgage, a family, or paying down leftover student debt. So your $300 needs to work smarter here. First, before you invest aggressively, peel off $50 a month and put it straight into a high-yield savings account, or HYSA, which is currently paying around 4 to 5% API. Why? Because without a 3 to 6 month cash emergency fund, a sudden crisis, like say a blown transmission, will force you to sell your investments at the worst possible time. Next, put $100 toward maximizing that 401k employer match. And finally, the last $150 goes to a Roth IRA or a traditional IRA if your income is a bit higher now. If you're a really high earner, you might even want to look into a backdoor Roth strategy. And this breakdown brilliantly illustrates the real cost of waiting. If you start this exact same $300 a month strategy at age 30 instead of 25, you are still going to be a millionaire by 65, finishing with about $1.05 million. But look at that gap. Delaying your start by just 5 years slices roughly $850,000 off your potential future wealth. Literally, every single year you wait in your 30s costs you roughly $100,000 in future money. Section 3, your 40s. The catch-up time. Now, if you're in your 40s and you are just starting out, hey, take a deep breath. You absolutely haven't missed the boat, but your strategy does need to be incredibly focused. You don't have the luxury of making wild speculative bets anymore. Still, investing $300 a month for 25 years at a 10% return builds a very solid nest egg of nearly $400,000. When you pair that almost $400,000 with Social Security and any other assets you might have, you're building the foundation of a very real, very livable retirement. You still have a clear runway ahead of you, and your secret weapon unlocks at age 50. This is when the IRS allows you to make extra catch-up contributions to supercharge your accounts, an extra $1,000 a year to your IRA, and an extra $7,500 to your 401k. Furthermore, because you are likely in your peak earning years right now in your 40s, utilizing pre-tax accounts like a traditional 401k is absolutely critical. It actively reduces your tax bill today, which essentially lets the government subsidize your retirement savings. As you get closer to retirement, how you actually allocate those funds becomes vital. Target date funds are incredibly useful for this. As historical data from Vanguard shows, different mixes of shares and bonds offer entirely different spectrums of returns and risk. A target date fund automatically shifts your mix from aggressive, higher-risk stocks to more stable, lower-risk bonds as you approach your specific retirement year. It's just a fantastic set-it-and-forget-it strategy. It smooths out your returns and manages risk so you aren't heavily exposed to a random market crash right before you need to tap into the money. Section 4. Compound interest, the actual engine of wealth. Let's really look under the hood to see exactly how this growth happens. It's the phenomenon of compound interest, generating interest on your initial investment and then generating interest on that accumulated interest. Running these numbers, the snowball effect is undeniably clear. If we factor in $300 a month at a 10% return, boom, a 25-year-old reaches nearly $1.9 million. But change that starting age to 35, and the result drops to $905,000. You literally cut your wealth in half by waiting 10 years. Change the age to 40, the result is $398,000. We can clearly see the exponential ripple effect of generating interest on interest over varying time frames. Time in the market is drastically more important than trying to time the market. The overarching takeaway from all these financial models, whether you're looking at Bankrate or Origin Financial, is that stopping your attempts to beat the market and simply committing to a consistent, boring, reliable strategy is how wealth is actually built. Good investing doesn't involve chasing down the highest returns on social media because, let's be honest, those are hard to find and way harder to repeat. It's about automating your contributions, ignoring short-term volatility as just noise, and letting long-term trends be your signal. Consistency beats intensity every single time. So I'll leave you with this provocative thought. Wealth is not about how much you earn. It is about what you do consistently with what you have. The math absolutely proves that the second best time to start investing is today. So what exactly is holding you back? Drop a comment below with your age and let me know if you're starting today. And if this explainer helped bring some clarity to your financial future, please hit that subscribe button so you don't miss our next deep dive. The best financial decision you'll ever make is the one you actually follow through on. Start today.